All right. Hello, everyone. Thank you for joining us today for part four of MMFCU's Financial Health Series, How to Build Your Credit webinar. My name is Jackie Lopez. I'm the marketing manager here at the Credit Union. Joining us today, we have Andrea Gideon. Andrea is the financial literacy coordinator at Springfield Technical Community College. Her goal today is to educate us on what a credit score is, how the score is factored, why it matters, and the different strategies you can help to improve it. So thank you, Andrea.
All right. Thank you, Jackie. So, welcome everyone. Welcome back. We had a little bit of a break from our last series, but I'm happy to join you again to present the last one for Become Semesters here at STIC, but for this particular series. I do want to preface and say I apologize in advance. I am a little under the weather, so you might hear some intermittent coughing or sneezing, and for that, I apologize in advance. But let's get to it. So for those who have attended to the webinars before, I'm sure you guys are familiar with me already, but for those who haven't, as Jackie said, I'm the financial literacy coordinator here at Springfield Technical Community College, and I am very passionate about financial literacy and bringing awareness to anyone that's willing to listen, but even more so to our younger demographic, which is why I feel so blessed to have truly landed my dream job. I know it sounds cheesy, but it's true. But enough about me. Let's get started because I'm here to talk to you today about how to build your credit. I can't hear you, but I can just feel your excitement. So let's get started. All right. So just to recap, part one was financial goal setting. Then we did a Valentine's theme series. For part two, getting financially vulnerable with your partner. Part three was creating a budget and saving money. And now today we are on how to build credit. So what is credit? Anybody have an idea as to what that definition would look like? If not, well, it's pretty simple. It's the ability of a person to obtain goods or services before payment based on the trust, and that's the key word, trust that the payment will be made in the future. Now, this trust, if you will, can go one of two ways. The first being a more safer route from the eyes of the lender, right? With the extension of secured credit. And the other is being unsecured credit. Well, being in the industry, I'm sure most of you have heard of these two terms and know the difference. But if you bear with me just a moment, I can further explain to anyone who may have not heard about the difference between secured and unsecured. All right, so it's definition time. We'll start with secured credit. According to Equifax, secured credit cards are a special type of card that requires a cash deposit, usually equal to your credit limit, to be made when you open the account. The money then acts as collateral every time you make a purchase, making you less risky of an investment from the eyes of the credit card company. Unsecured credit does not require a cash deposit. You still have a credit limit, but are considered more of a risk to the company if you default or don't pay your loan on time. Now, one of the things that I want to mention about secured credit cards is oftentimes what they'll do after your review period, which is usually about a year, you can always go back to that company and say, hey, I want you to take a look and review my account. I've made on-time payments towards a secured card for, the required period, which is usually 6 months to 12 months, depending on which company you go with. But what they'll do after that period is they'll take a look at your account. And if, all things look good, oftentimes what they'll do is they will reimburse your deposit money that you put on the card, right? So you'll get that back, and sometimes plus interest. And then they'll convert the card to a unsecured credit card for you. And that's really awesome because you've already established a relationship with this company. And so you get to continue that in a unsecured credit card manner. Now, these two terms may sound like they're polar opposite, but they actually do have quite a bit in common with each other. So both secured and unsecured credit cards offer a set credit limit that can be borrowed against. They both have the ability to offer cashback, points, and other types of rewards based on the company you go with. And they both charge some sort of interest and fees on balances owed. Both are required a minimum payment each month, and both are impactful to your overall credit score. The differences are unsecured loans are harder to obtain because you are considered riskier. There's a more involved vetting process, right? Unsecured cards do not require a cash deposit, so they're willing to, lend you this credit limit without having to put down the collateral. And unsecured credit cards have potentially high credit limits. So if you're building credit, you may want to start with a secured credit card to improve your credit score, which will make you look more trustworthy to the credit card companies for the unsecured card. This might also be a good way to go if you're trying to teach discipline to a child or, student about making on-time payments without having to run the risk of their credit being impacted. And some examples of a secured loan is that's actually a typo, but car loans are a type of a secured loan. And then an unsecured loan, an example would be a credit card. All right. So you've learned the difference between unsecured and secured credit cards. Next is types of credit. You might be asking yourself, how much more is there? And the answer is layers. There are layers to this. And the more informed you are, the better your financial decisions will be. So back to types of credit. We have revolving and installment that we're going to talk about. So revolving credit allows you to borrow over and over again up to an approved amount. Installment credit, you borrow a fixed amount over a period of time, a one lump sum loan, and you pay it back with interest. And then we have open credit. This type usually doesn't have a hard set credit limit, and payments are due in full every month, but the amount you pay is usually based off your usage. So to explain this further a little bit, a revolving credit is very similar to a credit card in the sense that you have your overall credit limit when they say, hey, John Smith, you've been approved for $1,000 limit. And you swipe your card, you spend $200, you make your payment at the end of the month. And then you have up to that $1,000 limit to keep using over and over again. With installment credits, they're a little bit more strict, I guess you could say, in the sense that when you go and you get the credit, the money, it is usually given to you in a lump sum, and it typically does have to be towards something specific. You're not allowed to deviate from the use of those funds that you agreed upon with the lender. An example of that would be a car loan. Typically, when you go get a car loan, you don't just say, hey, I want to go get a personal loan for $30,000. You go and you apply for a car loan. Same thing with student loans and a mortgage. All those things are specified before you get the lump sum of money, and then you pay it back with a usually fixed fixed interest rate. That right? And open credit, which isn't as common as the first two, but open credit is kind of like a personal line of credit where you're given an overall amount that you can spend up to. It doesn't have to be for a specific purpose. And you pay based off of the usage of how much you've taken out on those funds, plus interest. All right. All right. So it is definition time yet again. Anyone want to guess the definition of credit score. You can certainly pop it in the chat if you feel like you got it. No cheating or using chat GPT. But all right, let's get to it. So a credit score, according to consumerfinance.gov, is a prediction of your credit behavior and how likely you are to pay a loan back on time based on information from your credit report, of course. It is typically comprised of a number between 300 and 850. Now, contrary to popular belief, this isn't a one and only type credit score. Your scored number can vary depending on which credit report agency or CRA, as they tend to go by. It depends on which one you're using. Why? Because different agencies use slightly different means of calculating that number, whether it be Equifax, Experian, or TransUnion. I know from personal experience, I have a credit card that doesn't report to TransUnion, but does to Equifax and Experian. So whenever I see my credit score from TransUnion, it looks slightly different because I don't have the longevity of that card being considered, the balance and everything else. Again, I get it. Why do they have to make this stuff so complicated, right? Well, I just think of it this way. If we all walked around with great credit scores, then there wouldn't be enough money to lend us all. Well, at least that's my own personal take on it. So before I move on to the next slide, does anyone want to take a guess and pop into the chat the 5 different factors used to comprise your credit score? You're kind of curious to see, if you guys have an idea as to what that looks like. There, I'll give you a second moment. So we put credit usage to available credit. Okay. History of credit, payment history, amount of credit line, and how long you've had credit. That's pretty good, Alexia. I like it. All right. So let's see. We have 5 different factors that get taken into account. The first I'll start with is credit inquiries. That makes up 10%. And basically what that is how often you apply for credit cards or loans. And yes, this matters too. Too often you can end up looking like a huge risk to creditors if you are the type that is constantly applying to credit cards in a short period of time, especially. Next would be account mix at 10%. And this is just simply the different types of accounts that you have. Word is that they do like to see a mix. So if you have a credit card mixed with, the past payment of a student loan or a car loan or a mortgage, they do like to see a variety of different things rather than someone who just has taken out 6 or 7 credit cards. Next would be average credit age, which I know is something I think Alexia might have mentioned in the chat. And that comes in at 15%. And basically, it's how long you've had your accounts open for. Fun fact, I did some studying or research rather for a presentation I did to the students here at Springfield Technical Community College. And I did mine on buy now, pay later loans. And that's basically like Klarna, Afterpay, those type of things you see advertised in the payment section when you go to buy stuff online. And I didn't know this until this research, but how often you select those options to pay later does affect your average credit age, because every time you accept a buy now, pay later loan and you pay it off, it gets reported as part of your credit age. So if you think of it where because generally they have a 4 installment payment period. So if you think that you do that, let's say once a month, you buy something online and you do Afterpay, even once every 2 months, you are now showing a very short payment or age history on your credit report for something that, you could have just purchased with your card and not have had that negative impact on your credit age. So that's definitely something to think about. They had a story in the research that I was reading from someone who had pretty stellar credit, had no idea that this was happening in the background. And when he went to go pull his credit score around his annual time, he saw a very big decrease. And this was the reason. So just some food for thought. Next, we're going to talk about credit utilization, which comes in at quite a big chunk at 30%. This is how much of the limit you have reported at the end of your cycle that gets reported to the credit bureaus. You always want to try and remain under 30% of your available balance at the time that your balance is reported. But even better would just be paying the balance off in full, right? And another tip that I want to mention is a lot of people get confused with the credit utilization being 30% and then keeping your credit card under 30%. So I just want to give an example. So if you have a credit card, let's say a $9,000 credit limit, you want to make sure that at the time your card gets reported, that you do not have a balance more than $3,000 of that $9,000 limit. And then the other tidbit that I would share with you is try to make sure that you pay it down under that 30% utilization before the end of your statement date, not by the end of your due date. Those hold two different responsibilities, I guess you could say, when it comes to credit card statements. By the time your due date has come, your credit card company has already sent your balance over to the CRA. So we know the CRAs are the credit reporting agencies, right? For them to calculate your credit score. So if you don't want a balance to be taken into consideration in a negative way, like you're going to pay it down, make sure that you pay it down before the end of your statement date. And typically your statement date can be found at the top right-hand or left-hand corner of your credit card statement. And you'll be able to see there, for example, mine, I think, says from May 4th to June 3rd. And I want to make sure that that payment gets put in and applied before June 3rd. So to be on the safe side, you may want to pick a couple of days before that because, again, these credit card companies want to charge that interest, right? So some have it that it has to be made by 1 p.m. or 2 p.m. on a day in order for it to count. So just make sure you read the fine print and make your payment before the end of your statement date. And then lastly, we have the biggest one of all, which is payment history. And this is how well you do with paying your bills on time. When you pull your credit report, typically they will show you a calendar. I think it's about 24 months back. And anytime that you've had a late payment, it gets recorded. And when it gets recorded, it gets factored into your credit score. When lenders go, or if you apply for a card, this is something that they're looking at. How many times did John Smith miss a payment? So please be mindful that payment history, as you see, is the most impactful way to make changes on your credit card. some people set up automatic minimum payments. So to avoid missing a payment. Another way, again, just driving it home is to pay your card off in full and there won't be a payment to miss. But whatever it is, make sure you set up something to ensure that your payments are sent in on time. So that way you don't become negatively impacted by your payment history. All right. So here is a list of your credit score, ranging from bad to excellent. I'll show you what this looks like in terms of taking out a loan in a few slides. But before I move to the next slide, when was the last time you pulled your credit report and pulled your credit score? Now, you may or may not know, but these two things do require separate actions. Some people tend to think that the word credit score is synonymous with credit report, and though they go hand in hand, they are not the same. Rather, one kind of determines the other. So here we have a range of credit scores. As I mentioned earlier, I believe it's 300 is the minimum, 850 being the maximum. So anywhere from a 750 to 850, you are in excellent credit range and typically will get some of the best offers when it comes to loans. And 700 to 749 is average to very good. 650 to 699 is fair. 600 and 649 is poor. And then anything below 599 is just plain old bad. When it comes to buying mortgages, or taking out a mortgage rather, I know sometimes they let you buy points when your credit score isn't up to par. But overall, especially when dealing with a mortgage with such a high balance, you want to really try and make sure that you get into it with the best credit score that you have to try and get the lowest interest rate you have, as that in turn will determine your payments. So case in point, don't rush when it comes to mortgages. Make sure you have all your ducks and credit in a row. All right. So how to read and acquire a credit report. What is on the credit report? Well, it's a list of past and present credit accounts and loans, including your credit cards, student loans, car loans, how much money you owe, and whether you've been on time or late with those payments. It is important to check your credit report. So you want to do that regularly to ensure the information is accurate and complete. And you can always make corrections if you do find something that is incorrect. There is a way that you can file a dispute with that credit card, with that credit reporting agency, the TransUnion, Equifax, or Experian. They have means for you to write them and say, hey, I want to dispute this. This information isn't correct. Whether it be, I paid off this card 5 years ago. Look, I have a statement, my balance is zero. Or I never took out this card. There are ways for you to contest it. And then how to get your credit score. Or credit report, excuse me. So the annualcreditreport.com, which is the only free government mandated site. So don't fall for those other ones when you start to Google this. But this is the only legitimate site reporting for the three agencies. You are allowed to request one report once per year from each of the three credit bureaus for free. And the MassMutual app and online banking can provide you your credit score, factors that impact it, and the things that you can do to strengthen it. Okay, so we're going to move on to why your credit score is so important. Well, a good or excellent credit score, as I mentioned, will save people hundreds to thousands of dollars. Someone with excellent credit gets better rates on all loan products over someone who doesn't. Poor credit ratings are considered higher risk borrowers, meaning they are going to incur higher borrowing rates. A poor credit can also affect your ability to find housing, rent a car, even getting life insurance, and sometimes now even employment. Um, I've heard that sometimes employers do look up to see how you are with your credit before offering a job. Now, remember when I told you a few slides ago that we would further discuss how your credit could impact your pockets? Well, let's take a look. So, for example, if you were to take out a car loan of $25,000 over a term of 5 years, and I think some places are even going up to 7.5 years now, but I would strongly advise against that. So we'll stick with a 5-year term. If you have good credit, in an APR of 3%, your payment would be $449 a month. Total interest coming out to $1,952. Not too bad. Someone with poor credit could end up paying 18% on that loan, payments rounding out at about $634, and then your total interest being $13,077. Now, mind you, this is just the car loan. We're not taking into account maintenance, gas, or even insurance. So this is why I say it's important to make sure that your credit is in good order before looking to borrow large sums of money. Makes a big difference. All right. Let's get the right place. There we go. How to improve your credit score. So that's what we're going to talk about next. And let's see. Oh, so here I want to insert a fun clip for you. Just bear with me a moment here. Now, last time, there was some issues with it not being heard. So please let me know in the chat if you guys can't hear the video this time.
Yo, every time. What? Do you really have to come in like that? Yes, Cameron, say. What's up? What's your credit score? Oh, I don't know. You don't know? No. To be honest, I don't even really know what that is.
Well, it's a score of your credit.
Yeah. Okay. Yes. I put that.
You really should know what it is.
Should I really?
I mean, is it Popper right after Labor Day?
I don't know. Yes, he does.
Okay. Well, I'll just check it.
No, you can't check it.
Why?
That'll lower your credit score.
Checking it?
Yes.
Okay, well, it's not a big deal anyway because I don't even have a credit card.
You're joking.
No. Well, so your credit score is 0. Problem solved.
Oh.
Should I get one? Should the Pope invest in a really good dry cleaner?
Yes.
Yeah. Okay. I'll get one. I guess I'll just sign up for this basic balloon that works. The only thing is I don't have a lot of liquid cash, so I wouldn't be able to pay off this full balance every month.
Well, then it'll lower your credit score. Really?
Does the Pope wear white because it really brings out his eyes?
I don't know. Yeah. Okay. Well, then I will just cancel it.
No, why?
Because that'll lower your credit score.
I don't know what that means. One time, why are we doing it? Because we are all cogs in a machine, and the big banks are playing us like puppets, and we only have the illusion of free will.
Wow.
Lips. Heavy. Yeah. Sorry about that. Guess I have a credit card now. Or do you want to go shopping?
I mean, yeah.
Sure. Let's grab my bag.
All right. Hopefully you guys were able to hear and enjoy that. I didn't see anyone say they couldn't. So I thought that was kind of a fun skit because sometimes your financial journey can feel just like that. Like, what am I doing? I can't do anything right. And that was just to show you that you're not alone. It's a learning process, right? So, a couple things. You want to review your credit report at least once a year to help you see what you need to fix or what's working for you or what's working against you, and dispute any errors that you come across. The next thing you want to do is pay your bills on time. As we saw in the previous slide, this does impact you at the biggest percentage, 35%. You can automate. Well, let me take this back. If you are someone who is disciplined with your spending, I would suggest automating your bills at the minimum payments just to make sure that you don't miss a payment. Take a look at your bills, figure out when you get paid versus when the bills are due. Sometimes that might mean reaching out to your credit card company and changing your due dates, which is a thing. Not everyone knows that, but you can also call in to change when your due dates are, so that way they better accommodate when you get paid. So that's one thing that you can do to pay your bills on time, or create a filing system. Sometimes the old school way of just having things on paper or a calendar work best for some people. I know that works best for me personally. So you have that as well. Keep old accounts open. So this goes to that credit age mix that was, I think, at 15%. The older your credit age, the better. And what this basically means is if you take out a credit card at age 20, and say you don't really have a use for it, so you're thinking about closing it at age 28, think twice, because that 8-year term that you've had that card open, especially if it's with healthy payment history, is calculated into your overall credit score. When you close it, they are no longer using that 8-year term to show how long you've been making steady payments, which for a new creditor pulling your credit report might make you look a little riskier in the sense of, can this person be trustworthy to make payments over a long duration of time? So keep those old accounts open. Some of them do require that you use them from time to time, so definitely check the fine print there. And then some probably have annual fees, so check into that as well. But overall, if you can, try to keep them open. Next is the 30% utilization, as we talked about. It's, again, ideal to pay your credit card balances in full each month, but primarily just making sure that you keep it under that 30%, because it is going to be calculated at 30% of your credit score. And one way around this, too, is asking for a credit limit increase. And again, this goes back to whether you're diligent or not. So if you have a credit limit with, say, Visa for $5,000, then you see from your credit history that you're typically, utilizing 50% credit utilization. Every month, you're carrying a balance over of $2,500. That's not doing so hot for your credit score. So what you could do is reach out to said credit card company and say, hey, I wanted to know if you could review my account and see if I would qualify for a credit limit increase. Typically, they'll take a look, and oftentimes they do approve you, because for them, that means that you're just going to swipe that card more. But you're not. What you're going to do with that credit limit increase is help you maintain under your 30% utilization. So with that same example of the $5,000 credit limit, say after a review, they say, okay, we've taken a look at your account and we're going to actually give you a $10,000 credit increase or limit in total. If you maintain that balance of $2,500 or less, now your utilization has dropped 30% by doing nothing but simply increasing your credit limit. So if you are someone that, doesn't like to shop on a whim and might be tempted by having that increased credit limit, this may be a way to help increase your credit score. All right. Next, you see it say, limit new credit. Soft inquiries don't hurt your credit score, but hard inquiries can stay on your credit report from a period of months to years, just depending. That is with the exception of, say, when you purchase a car loan. Typically, they do give you a time period to shop where you can have your credit report pulled for harder inquiries from different banks for a period of time while you try to find the lender with the best rates. So that won't impact you, but neither do soft inquiries. But if you do too many hard inquiries within a period of time, that can be frowned upon because now you look more like a credit risk than someone who has money that just wants to get more money. I know it doesn't make sense, but it's just the way the cookie crumbles. And then if you don't have a credit score, the MassMutual Federal Credit Union team would love to work with you one-on-one by starting to build your credit responsibly. So you can always reach out to someone on Jackie's team or Jackie directly, and I'm sure she'll point you in the right direction for that help. Okay. So next, there's some facts and myths about credit that we can review. So the first one says, how long does it take for negative information to age off your report? Well, negative info tends to stay in your report for different periods of time, as mentioned, but generally it takes up to 7 years. So that's some food for thought, right? Because you can damage your credit score in a matter of a month with applying for too many credit cards at one time, but it can take up to 7 years to fully rebuild your credit score. And this is why the decisions that you make and actions that you take on your credit scoring is so important. All right, next one. Does paying off a car loan help or hurt your credit? Excuse me, paying off a loan in general, help or hurt your credit? If the loan that you pay off is your oldest credit line, then the age of your credit will be newer and your score will drop. If the loan that you pay off is your only loan, then your credit mix will really suffer. So this is why it's important to have a good credit mix, because if you have a credit card and say a car loan, you pay off your car loan because that's the plan, right? You still have those consistent monthly payments being made with your credit card to show that you are, new to this and that you have a good credit paying history. Excuse me. Will paying the minimum on my credit cards improve my credit score? And the answer to that is no. You need to pay at least the minimum on your credit card every month to have on-time payment history. But paying your balances in full every month is ideal and will most positively impact your credit score as it improves credit utilization percentage. Another thing to consider when it comes to carrying balances on cards is most credit card companies use a calculation that calculates your interest on a daily basis. I think they call it like the daily averaging calculation. So if you swipe your card for a TV on Monday and you don't plan to make your payment for another 2 Mondays, every day that balance carries over, a little bit of interest is being added. So that's why it's important to pay your credit card off when you use it. And most importantly, is to pay it off by that statement date. All right. And then the last one we'll get into is, how long does improving your credit score take? Well, how long it takes depends on why your score is low. If the major negatives are credit utilization, we got cut off there, sorry guys. If the major negatives are credit utilization, then you could look into reducing your overall balances to help improve your score. But if your score is low because of a collections bill, then that's something that you would have to take care of first, right? And it's going to take a little bit longer to work your credit score back up to a good standing. All right. Well, I kind of cheated and showed you guys the last slide. We are all done. That leaves us, a few minutes for questions that anybody might have and to see what everyone put in the chat. Let's take a look.
Awesome. Thank you, Andrea.
No problem.
Would you like me to read some questions for you?
Sure. And we're
All right. Why is it that your credit score dips after paying off a car loan?
So I think that was answered in the last slide where, and they might have asked this before, looks like earlier on, but it dips because it's not being calculated anymore. So you spent 5 years making payments, right? Every month on time, good history. And then you do the right thing in paying it off. This is why, you know, it's not a fun game, but you do right thing in paying it off. And now that 5-year credit history falls off. And because it's calculated in your credit score, it does impact your overall credit number.
Makes sense. Can you explain the difference between a FICO score and a credit score?
So a FICO score is a credit score. And I was going to talk about the whole Fair Isaac credit reporting, but I didn't want to muddy the waters too much. But those two are the same thing. What I was speaking of earlier was credit scores and credit reports. But the Fair Isaac is the most commonly used reporting for credit scores.
Okay. What might look better for your score? Having one credit card at 20% utilization or two cards at 10% each? Meaning, is it better to spread between two cards?
Oh, this is a great question. I want to read that just to make sure I answer correctly. What might look better for your score? Having one credit card at 20% or two credit cards at... Well, I think this depends. And Jackie, feel free to chime in here. I think having two credit cards with 10% each is going to look much better. But I would only caution because I wouldn't recommend going out and opening two new accounts because you're going to do damage before it looks better, right? But if you already have two credit cards, it wouldn't hurt to consider doing a balance transfer. So that way you're spreading out the balance between the two utilizations that you have at 10 and 10.
I'd agree. The last question I have is, do micropayments help build your credit faster? AKA making multiple smaller payments each month before your statement date or before your monthly payment is due?
So I've heard of micropayments in terms of keeping your interest low, your interest rate that gets calculated. I'm not familiar with micropayments as far as building your credit score faster. I would say, my personal opinion, not so much, because your credit score is calculated at what gets sent to your credit reporting company. So, for example, TransUnion. If the balance that gets sent to TransUnion at the end of the month is $2,000, I don't think it matters if you made 5 micropayments to get your balance down to that $2,000 or if you made one lump sum payment to get your balance down. I feel it's just what's reported to them by that statement date. What are your thoughts on that one, Jackie?
On the micropayments, I think it's an individual preference because I don't think it affects the credit score that much, but it definitely helps people
Pay the balance.
payments, especially in this type of economy where some people have to choose and prioritize what they can pay. Sometimes it helps to make the smaller payments and base it off of when they get paid versus just paying it all in the due date.
Absolutely. All right. Thank you.
There've been a couple more since then. So if a loan is paid off, it will then drop off your credit report. But if you use services like Klarna or Afterpay and pay it off, still shows and lowers your average credit age, even if it's after been paid.
Sorry, I'm going to read this for understanding. Right. So with these installment companies, that these buy now, pay later companies that have been popping up over the last couple of years, there isn't much regulation to them. And unfortunately, they, it's one of those things where they report, and what they're reporting on can hurt you, but unfortunately, you making your payments on time with them doesn't help you. So if a loan is paid off, it then drops off your credit report. That is correct. But if you use services like Klarna or Afterpay and paid it off, it still shows and lowers your credit average even after it's been paid. The answer to that is yes and no. So if you use Afterpay and you pay it off, it's going to show that you have your credit age mix affected. I'm trying to understand the second part of this question. I apologize. It shows a large average credit because it affects, not because of the balance, but it affects it because of the credit age mix. I hope that answers the question. If it doesn't, feel free to let me know, Jordan, and I'll try and tackle it a different way.
And then Alexia's adding into the Afterpay Klarna as well, saying she's personally seen with Afterpay and Klarna, if she makes any payments ahead of the due date, her credit score has increased by a few points. Have you seen any other insight with Afterpay and Klarna?
So that's actually interesting because the research that I didn't have at the time, this is probably 2 years ago, at the time didn't have too much information, the studies that have been done with it. So that's great if it did increase your limit. In regards to, have you seen any other insight with Afterpay or Klarna? I know it seems to be coming the wave of the future, and they're looking to put more regulations on it, where my research shows that there's huge cause for concern is the companies don't communicate with each other. And so that can be very concerning because you could have a loan out with Klarna, you can have a separate loan out with Afterpay, you can have a third loan out with, I'm sure there's another name out there.
Affirm.
Yeah, there you go, Affirm. And because they don't communicate with each other, that's when people get in that tricky spot where if you miss a payment or you don't have enough money for the automatic withdrawal that comes out, that's when it can start to negatively impact you as well. And they're not mandated to report, from what I understand too. So that can get kind of tricky as well. But that's all the information I was able to gather at the time.
All right. Jordan did clarify her question. She's wondering why buy now, pay later services continue to negatively affect your average credit age after being paid off. The loans no longer affect your credit age once paid off.
So it doesn't affect it after it's been paid off. It's just at the time that it drops, just like the car loan example. So because you took that loan out for such a short period of time and it gets paid off, it gets calculated into your overall age mix. It's not that it still impacts you after it's paid off. It just looks like a lot of short-term loans that you took out rather than having a credit card that stays open and just a balance every month. I hope that answers it. Exactly. So she put, I understand. And because people will use these consistently, generally, you will have multiple open at all times. Exactly. And that's where it gets dangerous. And I've seen it even with some of my students. You're welcome. That one was hard to verbalize into words, so I'm glad you were able to make sense of what I'm saying.
You know, all these buy now, pay later options, it's tough to understand when it's brand new. And I think we're still trying to navigate that as, you know, it does really affect your credit score in such a different way than what we're used to.
Exactly. No, I completely agree. And they make it so easy to acquire them. So You know the rule of thumb, when it's that easy, what's the catch, right?
Absolutely.
And some of those fees for missed payments or bounce back, if you don't have the money in the account when they go to pull, are astronomical, and some oftentimes more than the cost of the item that you purchased. So it's just a lot of small things to be aware of when you're doing those buy now, pay later loans. All right. Well, I think that's it for questions.
Yeah.
As I said in the very beginning, everyone, I hope you were able to learn something or take away something from today to implement into your financial wellness journey. Remember that it is a journey, so it's not a let me do this budget, set it and forget it. As I mentioned before, you need to revisit. Life happens, things change, and your finances need to be fluid in that sense too.
Well, thank you, Andrea. I appreciate your time and explaining this all to us today. If anyone does have any questions at a later point in time, you will be receiving an email today with the survey, the recording, and the presentation, just so that you have everything at your fingertips. But don't hesitate to ask any questions and just reply to that email.
All right, great. Thank you guys for having me. I look forward to working with you guys in the future again. And everyone have a great and safe summer and spend wisely.
Yes, thank you.
You're welcome.